Our next article today is that mortgage rates fall after remarks by Fed President Waller. Now, this is kind of it's the headline, but it's really not the entire story. It wasn't because this guy said something. It's because of what the data reported said. Now, they're referencing in this article the 10-year yield, which I am always sharing with these guys. I'm, texting them screenshots. Hey, look at the pricing going this way, pricing going that way. Yeah. So this is like Andy's little nerd corner for a second here. But what really happened is that mortgage rates started nosediving because of economic data.
Yeah.
So what's happening with rates now? Where are they going next? What's your prediction for looking at the end of January, beginning of February?
So we just had a good last week of rates. I mean, the pricing was good. And one of the things that, I have to remind people is that when they say rates are coming down, it's not necessarily like the rate tanked to like 0.5% or a full percent, but the pricing and what it is going to cost you to get that rate is starting to get alleviated. And what I believe and what's been happening is that I see a lot of the, inflation readings coming in, like we've been talking about, not lower, but, right in mark with what we're, expecting. So I think the Fed still has a bigger issue, controlling the labor market, that inflation isn't that big of an issue anymore. Therefore, we're able to see, those good days in pricing throughout the weeks. But I feel that as we progress into February, rates are going to slowly continue to trickle down. And then we'll see what happens when the Fed speaks, at the end of this month.
Well, may the interest rate gods hear your prayer.
Please.
It's again, data says everything. Yeah. It's all about the data. I used to not really understand it like that, but I'd be like, just gonna take a hunch. But data is everything, and so everything has to do with the labor market. So the stronger the labor market is, that's not broken, nor does it look like it's gonna be broken. I mean, 2 weeks ago, 200 some thousand jobs were created. Way more than expected. That took rates just boom, letting people know that, hey, you know what? Oh, more jobs, therefore they're going to be more spending, therefore inflation is going to be higher because we just keep spending it, and that's it.
And then when we got inflation readings, last week, one of them was a little bit higher. I think it was the year over year or month. Yeah, year over year. And rates started doing a little bit better. So it just shows you the difference of, what impact, rates have against, of that.
The maddening part of this is sometimes when inflation comes in hotter, rates do they go the other way. And then in this case, if it came in hotter and like, oh wait, now rates have to go down. But here's the other maddening part is your memo's bringing up the labor numbers. Yeah. Yep. And remember, this is how convenient is having a short-term memory for the market, because the Fed and whoever's reporting a BLS and all that, or not, BLS, Bureau of Labor and Statistics, who's reporting all this, they very conveniently are hoping everyone's forgotten that they accidentally added 880 or 80, however many,
880,000
more jobs than were actually created. So that seems very convenient. So when you say the number 200,000, I'm like, well, was it really? Because now I don't even know. If you have to go retroactively, we actually overstated by 800,000 jobs. That's a wild miss on the monthly average. Yeah. And so you're telling me 200, my mind's thinking it's probably half that.
But you look at the numbers and they always get, readjusted every month. Every month they go back and readjust, and they're never higher. Also, they're never what it was when they first.
Also note from this article, missing terminology. For those of you keeping score at home, there was no reference of soft landing.
Yeah.
Still, because guess what? They stopped using that a long time ago. And so for those of you keeping score at home.
What about transitory?
Mortgage Heroes 3, the Fed 0. I think we said from the onset, like soft landing, get out of here with that noise. That's not happening. It's not happening.
Still not happening.
No, and I ranted last week on the show about inflation because, again, the whole speaking point comment about inflation is going down, it is not until there's a negative in front of the number. Now, we did see that in some of the categories that are measured in inflation. Some of them had little negative handles ahead of them, like car prices I saw was one of them, gasoline was another one, but some others did not. They were actually up. Things like groceries were up still. So again, there's these nuances you have to talk about and realize that overall inflation is a big issue, but to your point, Memo, they have changed their target. The target is not inflation anymore. It is the labor market, and man, they are hooked on it.
Well, again, how do we pay a deficit if the labor market's weak?
You can't.
So that's where the Fed's teeter-tottering with the inflation and labor market. They just can't get it right.
So there were some calls for some people saying, well, shoot, the Fed, they should not have reduced the rate. They should not have done rate cuts in 24 like they did. Now looking back and saying, well, they might need to go do a rate hike to correct that. Yeah. And now you see some people saying, well, they might actually now have to do rate cuts towards the end of the year. Like, which side of the argument do you guys find yourselves on?
I find my argument on the side that the government, obviously, they have to figure this out. The debt is so high. that they have to refinance these loans. So by reducing the Fed funds rate, it is a convenient tactic for them to be able to reduce what those payments are going to look like in the future. So I know that they were saying that this year we were going to have 4 rate hikes. Now it's going to 2 rate hikes.
Cuts or hikes? You're saying hikes.
Sorry. Cut hike. No.
Hike, cut.
They were gonna cut the rates 4 different times. Now it's gone down to 2. And now, based on this information, with other players in the market, they're saying maybe that's not even good for you guys. Maybe what we should have done is just done a rate hike instead.
So what do you think is most likely to happen, in your opinion?
My opinion, they're going to reduce the Fed funds rate.
They're going to
do it again. They're going to need to cut because they need to, again, we have a $36 trillion deficit. We need to pay that somewhere or another. When these treasury bonds are being, cashed in, we need to be able to refinance that.
Yeah, I heard there's upwards of $7 trillion that's due to be refinanced in 2025.
There you go.
Of that 37 trillion.
So imagine that. 0.25% makes a huge difference on that.
Yeah, on $7 trillion.
You know what I mean?
You got to pay the bonds and you got to pay your debt.
So those are the things that we got to consider. We got to look into. All of this is played out because we have to do it. It has to be done.
Okay, so Brian, are you on the cut side as well?
Yeah, I'm definitely cut. I mean, I'm not going to go into all that detail because Will kind of just literally laid it out perfectly. But I mean, I'm optimistic, and I want to say that we've been at this level for quite a while. Maybe we're not just going to get that sharp cut right away, but I mean, it's leading more towards cut than hikes for me.
So the projection here from HousingWire is that we could see mortgage rates between a very wide range of 5.75 to 7.25, which we kind of already sniffed 7.25 at the beginning of the year.
We're still there right now. I'm sorry, guys. We're on there. We're still on there. It hasn't gone down.
I was going to say, to Brian's point earlier, is even though there might be a pricing change on the market, it's on the backside where maybe instead of having to pay to buy down your rate X amount, you're paying less to get that same rate. It has not affected the actual interest rate that's assigned to your scenario yet.
And I really feel that needs to get communicated more, because a lot of people just hear rates drop and it's like, well, it's the same rate. Well, it's a lot cheaper if you would have came to yesterday. I mean, it's a lot more expensive yesterday than if you would have came today.
It's still going to take a lot more downward pressure for it to actually start impacting the actual interest rate sheet. Yeah. It's affecting the cost to get interest rates, but it's going to take a lot more pressure for it to actually start marching those rates down by 1/4, a half, or a full percent. So the projection of it being at 5.75, I think, is really aggressive. I don't know that I agree we're going to get below 6 this year based on what we're seeing. It's January. I know it's January. But look, if I had to make a snapshot in time and say, where would we be? I don't think we're below 6 this year.
No. I mean, on the government, hopefully we're in the 6s, but we'll see on the conventional side. But again, not only did we start off 2025 with these fires, but we started with the worst affordability issue ever,
which I feel like we said 8 times in 2024. Here we are, another month. Oh, affordability is worse. It's kind of getting again, I said the word maddening a little bit ago. It's like some of this is just so infuriating.
Not only that, Andy, this affects everything, even new home builders. They took a big negative hit. When rates are above 7%, the builders, because of all the incentives they have to offer to make it affordable for that new homeowner, they have to reduce their profit margins. Yeah. And remember, builders, the difference between builders and regular people is they see their homes as a commodity.
Yep.
They need to sell these things out in order for new money to come in so they can continue to do what they do best, is build. And so anytime rates are above 7%, that's when builders are just, I don't want to build right now. It's too expensive. And all that affects our market, affects the data.